Okay, hello everyone. In today's episode of Growing Your Tree of Prosperity, we're going to take a shallow dive into not just one stock, but 50 stocks. All right, and we're going to do a little bit of data exploration on Singapore's next 50 mid cap counters. All right, so let's dive right in. Okay, and basically, the folks in SGX have come out with a new index, and this comprises of 50 of the largest market cap counters that lie beyond the STI. All right. So the STI will have 30 of the largest blue chip counters that represent the Singapore economy, right? And we follow the STI every day on how it has done. So what the folks in SGX has done is that they've come up with a new index that cover 50 stocks. That means position 31 to position 80 in terms of market cap. All right. And this is a very interesting kind of development because it shows that our authorities are very genuine about not just moving liquidity into the largest counters in Singapore like DBS, but they're also interested in moving some liquidity to the stocks that do not fall into the STI. All right, and two indices have been confirmed. The IH Singapore Next 50 Index, which is based on market capitalization, and the IH Singapore Next 50 Liquidity Weighted Index, that is weighted by turnover. I'm not particularly interested in the differences between uh, these two indices. I would expect their movements to be very, very similar to each other, right? With a very slight difference. Okay. So if you look at the business sectors that these 50 companies are in, you will find that real estate holds a majority of the business sector. So you have real estate investment trusts comprising about 47%, which is quite high. So one way to imagine the Singapore Next 50 is that it is primarily a REITs index, okay, with 50% into REITs, the same way the STI is very strongly biased towards the banking sector. All right. So imagine this, right? STI 30, banks, Singapore Next 50, REITs. Okay. So that's a very simple and elegant way to look at it. But what I like about Singapore's Next 50 is that beyond real estate, right? Everything seems to have a very nice spread, right? Industrial services, electronic components. Okay, so definitely these 50 stocks, they are better diversified than the blue chip counters, and so it will be very interesting if we examine some of their properties right now. Okay, so how do we compare STI and Singapore's Next 50? So what I want to do is that I want to backtest an equal weighted index comprising the Next 50 counter against an equal weighted index comprising STI stocks. All right. So I'm not really interested in the way that they've weighted the stocks based on market capitalization. What I do is, at least the way I teach my students is that you should split the funds that you have evenly between the counters, right? And generally speaking, okay, very generally, doesn't do this for every part of the for different market regimes. Okay, if you spread your money evenly, it performs better than if you were to buy an ETF that concentrates on, for example, DBS, OCBC, and UOB. All right, so that's what I'll be doing. And for this round of backtests, I cover 1st of January 2015 to 1st of October 2025. All right, and I employ Yahoo Finance data to come up with the information. And so very clearly, the large market cap counter, the STI, it produces better returns. Okay, and there is obviously a higher risk. The standard deviation is about 13%. All right, the Sharpe ratio, 0.99, very close to 1. Maximum drawdown 32%. Okay, so the STI is still better. All right, the STI is still better. And the SG Next 50 has a slightly poorer return over the past 10 years at 10.6%, but it comes at a lower risk, right? And so the Sharpe ratio, well, it's lower, but it's lower by a little bit. The maximum drawdown, however, is higher at 35.55%, largely because the real estate investment trust crashed during the 2020 pandemic crisis where markets crashed. And naturally, if you have more real estate investment trust in a particular index, the performance is going to be worse. All right. Now, what is important is that the correlation between these two indices, right, equal weighted indices that I built, right, the correlation is 0.8, which is high, right? Which means that the performance of the SG Next 50 and the STI, they will go up and down together, right? And the correlation is as high as the correlation between, for example, DBS and UOB, okay? So you can argue that, well, SG Next 50 provide for the investor, all right? At the moment, the only way I can shape this narrative is that because it doesn't have a massive ETF that absorbs all the capital, right? You can expect that if you get into the SG Next 50 earlier than the people who create the exchange traded fund, you would be able to enjoy some tailwinds from that happening. Okay, right. And of course, if you combine the STI and SG Next together, then you are in a very happy place because what I've done is I've captured all the stocks that gave a dividend higher than 6%. Okay, so when you combine them together, the mid cap and the blue chip stocks, right, it's not too difficult. By simply taking this list of stocks and buying them in equal shares, you will get a dividend higher than 6%. Really fun, really attractive, and 6% is a decent number, right? Imagine if you have $1 million in the stock market divided between these counters, we're talking about a minimum of $60,000 a year or $5,000 every month, right? That is a lot of money for you to pursue your own personal interest. Okay, so you can really enjoy this page here. All right. Now the next thing I'm going to do for this shallow dive is that I want to do a little bit of factor analysis, right? I want to look at these 50 stocks and I want to ask myself these questions. If out of these 50 stocks, I cherry pick stocks with the highest dividends, what is my performance for the past 10 years, right? And I'm not just going to do it with high dividends, I'm going to do it with low price to earnings ratio and low price to book ratio. So in essence, we are trying to see whether applying a very traditional value-based kind of strategy, would it result in better performance when we look at these mid-cap counters, right? And in this case, I use a tool called Quant's Cafe, and my backtest cover 4th of October 2015 to 4th of October 2025. All right, so let's go through these results one by one. The first is if you were to apply a baseline, and we use a baseline for all 50 stocks, then our return is not too bad, 13.38% based on the two. It includes all your dividends. Standard deviation of 17% is fairly across the board, quite normal. And the Sharpe ratio is 0.61. Okay, and this is our baseline. That means you buy all 50, right? For the past 10 years, you would have done quite well, right? The worst case scenario is you lose 34%. Okay, now do take note that returns have only been very good from, I think, 2025, right? So for the first 9 years of this baseline, stocks have been languishing. But we all know that story, right? If you have been an investor in Singapore, you know that, we've been languishing for a certain number of years. Things only began to pick up when MAS and the government decided to have a value up initiative for our local stock counters. All right, so this is an excellent time for us to just enjoy what's coming next for local investors. Okay, so what happens if you were to cherry pick 25 stocks with the highest dividends? And every year we rotate into the next group of stocks that give a high dividend, right? If you do this, well, the bad news is that you will have a lower annualized return, right? Your return drops to about 11.33%. But the good news is that your risk goes down as well, right? And that's the whole point about being a dividends investor, because we know that we are trying to get better sleep at night, right? So we are looking for something with a lower risk. And the Sharpe ratio remains the same, right? And that's what we want to see. We want to see a Sharpe ratio that's consistent with the baseline. So it doesn't mean that if you were to select dividends out of the 50 counters, you pick 25, you're actually not getting underperformance. You're getting the same kind of performance, but because you're taking a lower risk, therefore the returns are going to be a little bit lower, right? The only downside is you notice during the pandemic, you would have lost 36% if your market timing is very poor, right? But nevertheless, as I've explained in many of my videos and to my students, right, the dividend strategy produces money for you in regular intervals so that you will be more resilient in the next downturn and you can live through drawdowns of 35, 36% because of the dopamine rush that you get when you receive dividends on your bank account, right? So this is very important. So there is always that psychological effect that allows maybe a person who's not particularly good at investing to beat a person that is very good at market timing, uses all these growth factors and these technical analysis techniques, right? We win because we are patient, right? We don't win because we are smart or we're good, right? We win because we're patient, we enjoy the fruits of our labor, and we focus on our worthy jobs, all right? So this is how you can interpret it, okay? Now, if you had picked 25 stocks with the lowest price to earnings ratio, right, then what would happen is you will get a fantastic return, right? You will get 21% return, but it comes at a very high risk. Okay, I actually do not know the details about what happens if you apply this strategy. Okay, my students do not use one factor to determine what stocks to buy, right? We should normally use three factors. All right, so but we know that low price to earnings works because you get a higher Sharpe ratio and the maximum drawdown is quite reasonable at 32%. Okay, so this is one way in which the people in my community we discuss how to begin, right? At least we know that if you want to begin with the next 50 stocks, right? And people say, so how do I get started to pick winning stocks, right? Out of these 50 counters, I would say maybe look for 25 with a low price earnings ratio, and then you can investigate and drill down further, right? And so this is what I call the first cut. Right. Normally, I take 3 cuts on the data, right, before we actually uh, let the strategy pass muster. Okay, and finally, the price to book ratio. This is for deep value strategy people, the folks that really like that old school Benjamin Graham kind of approach, right? So you would have looked for stocks that allows you to buy $1 worth of assets for maybe 50 cents. If you had done that, your returns would have been decent at 14.14%, in fact, better than the baseline, right? But your risk would have been high as well, right? And overall, your Sharpe ratio is exactly the same as the dividend strategy. It is exactly the same as the baseline strategy, right? So whether you pick dividends, price to book ratio, or the baseline, your outcome is going to be the same, except that the returns that you get is proportional to the risk that you're taking. All right. Maximum drawdown, however, is not pleasant, about 37%, likely because this strategy, my guess is that it basically captures a lot of real estate investment trusts into these 25 counters. And you're likely to be hammered during 2020, which is why your returns are not particularly good, right? Okay, so with that value dive, we've learned quite a bit about this SG Next 50 that I think hopefully the other gurus might not have been able to figure it out because they might not have the quantitative tools, right? So most of the key value measures do not lead to higher risk-adjusted performance, okay? So dividends price to book ratio does not significantly do better than the baseline, but the low price earnings ratio shows a little bit of potential for a selection of our performers, right? So that's something that we want to take note of, all right? And the students who are watching, my students, alumni who are watching this video should take note of this, okay? So do note that this is insufficient to come up with a workable strategy. In the classes I conduct, we normally apply 3 to 4 different factors, and we do try to get Sharpe ratios well above 1, all right, before we will pass it on to the next step, which is qualitative analysis, right? We use quantitative analysis to screen our stocks and find stocks that we want to invest in, but we use quantitative strategy, or we use qualitative strategies to go through analyst reports, do a SWOT analysis, right, to determine whether the stock is worth adding into our portfolio. some additional thoughts for me, and it's likely going to shape how I conduct lessons in the future. Because the correlation is relatively high, there is nothing wrong with me combining the STI and the next 50 into an 80 stock pool for me to conduct my quantitative exercises. All right, so this is something that I might consider doing in the December run of my program. Okay. And this combined equal weighted portfolio would be a very nice balance because it's got your big banks, you know, it's got business trusts, it's got real estate investment trusts within this class of 80 stocks. And it's actually good enough for retail investors to sort of play in and find, you know, a nice local portfolio that pays, you know, decently, hopefully at a high frequency and interval, so that instead of having one paycheck every month, you know, you can get like 400 paychecks every month, right? Sorry, 400 is a little bit too much, but maybe with 80 stocks, each paying twice a year, okay, maybe 100 paychecks every month, all right, if you can balance out, you know, the portfolio, all right? Okay, and I've not gotten to the point where we are doing a three-factor model yet. Early in December or in late November, I will try to build a strong three-factor model that can produce a list of 10 stocks for my students for further consideration. And that's all I have for the shallow dive. The talk is a little bit technical because I'm obviously speaking to the alumni of my program, because just to tell them that my early retirement masterclass is going through a lot of structural changes, right? The first structural change is obviously very important because this next 50 is going to be a very important new area to play in if you enjoy local stocks. The second structural change is to have some kind of uh, Python Jupyter notebook that would be able to automate uh, the questions that we want to ask about the stock that we're trying to analyze, right? So that takes a lot more time, and I'll talk about it in future videos as to what I'm trying to do. I have to learn the open AI libraries before I'm able to produce this solution. All right. If you like what I do and you find that my work is very logical in a way, I come up with a proper portfolio for people who like Singapore counters, then you can Google ERM intro and you take the first link. And I'll talk a little bit about my personal story. All right. So with that, that's all I have. Thank you very much, and I'll see you on the next video.